Hello, everybody. This is Jay Turo. I am the CEO of Growthink. Really excited to have three of the smartest and most talented management consultants and strategists that I've had the privilege of working with in my career. And we've got a phenomenal podcast here for you today. We're going to share some of the secrets that we've learned here at Growthink in terms of putting together financial models, financial projections, pro formas for companies of all types and sizes. So let me introduce our awesome panel. I'll start with Anna Vitale, our Chief Client Officer. Anna, hello. Great to have you here with us. And Anna
Great to be here.
In addition to having worked on hundreds of models that have raised hundreds of millions of dollars, maybe into the billions of dollars now over her career here. She's also supervised our team of analysts and consultants and strategists, and have worked on hundreds of projects of all types and sizes for clients and helping them achieve their growth and their fundraising and their liquidity goals. Also really excited to have Antonio Barzagli, our engagement partner, head of our London office and of our EMEA region, which is Europe, the Middle East, and Africa. It's so exciting. Antonio's perspective is global perspective. Being in London, has worked with clients all over the world, and also has done some of the most amazing and complex financial projections in our time here at Growthink. And Antonio, great to have you. Thank you for staying up here.
Thank you.
And really excited to have one of our brilliant financial analysts and consultants on the line with us as well, Predrag Milosevic. Predrag is joining us from Europe, and his ability, he's going to really go into some of the mechanics of putting together a great model. And Predrag, thank you for spending the time today, and looking forward to hearing some of your awesome insights. So welcome.
Thank you, Jay.
All right, so we're going to start out with some top level questions, and then we're going to actually dive in and share a financial model. So I'm going to start with Antonio, who really takes a strategic approach to financial model. I think it's a really key point that before we get into the actual building of the model, there's some key strategic questions that are answered in the process of putting together. So maybe Antonio, you can start there and just share some of your thoughts on the role of the financial model in thinking through the strategy of a business.
Yeah, absolutely. There's a lot of business planning and strategy work that companies do, and that's a similar work that we help them with. And the financial modeling, financial projections, it's a very important piece of that strategy work. In my opinion, it validates whether the growth plan is viable. And what I mean by that is a lot of initiatives are very good on paper. They're very good from a qualitative standpoint. But until you put that in the context of an economic roadmap, it's hard to see whether the business model is sustainable, when profitability will be achieved, how much cash will be or capital will be necessary for executing on that plan. So it's, in summary, it's first and foremost a validation tool, internal road mapping for a company. And then there's another functionality, which is to present it to external parties and talking about those capital needs.
I think that's a great segue to Anna when we talk about internal road mapping, and then a very common purpose that folks come to us and help with their financial projections, their financial models, which is presenting to investors to communicate an investment proposition. So maybe share some thoughts as to the role of the financial projections in a presentation to investors to attract outside capital.
Well, that's exactly right, Jay. And investors' biggest question is, how are you going to put the dollars to work to increase, sales, market share capture, valuation for the next round, et cetera. So a big use case of our financial projections, as Antonio mentioned, is for that particular case. So we're thinking about raising money. We're wanting to show sales pipeline and what drives that, what the underlying drivers are, so that investors are really clear, dollars in, dollars out, what that equation looks like. Another big thing in consideration is the operations of the company. So oftentimes going from a smaller founder-owned firm to one with many employees. Who are those people? What are their core functions? Are we covering the bases in terms of hires? And then finally showing that valuation increase and additional market share capture. So if we're starting at point A when money hits the bank in some predetermined amount of time, say 36 months, what does the company's valuation look like from there? And so the model allows us a very granular tool to workshop a lot of these different scenarios and help founders understand the numbers behind what their plans are and how those are going to be perceived by investors. And importantly, we always say in the case of raising money that a financial model is meant to be a defensible plan, that nothing ever goes precisely to plan, but the goal is to present something that's very defensible to investors and help build confidence with that audience that you know your business and you know what you need to do to take the business to the next level.
All right, great. I got some follow-up questions for both Anna and Antonio on those insights. I do want to turn to Predrag for some opening thoughts. Predrag is often tasked with, hey, get this financial model built. And when you're tasked with that, Predrag, maybe just some insights of where do you start? What's the first thing that you do?
Yeah, well, I always like to start by really understanding the revenue streams of the company. That is the main driver, like, of all numbers in the model. Not just revenue, but also cost of goods sold. Also, we always try to make sure that everything else scales with the revenue. For example, the hiring plan will also depend on the revenue. OpEx, marketing expenses, everything will depend on the revenue. And let's say the revenue streams are the most custom part of the model. We really take time to, develop something that makes sense for every individual client. Some of the later stuff like P&Ls, balance sheet, cash flow, that's more, let's say, standardized accounting. While in the revenue projections, you have, let's say, a bit of artisan part of this business. It's not all just like formulas and rules, but it's also finding the best way to get something that makes sense. So I would always start from there.
Antonio's going to share a model in a moment. Before we do that, I'd love, Anna, that I know you've had a lot of experience in working with lower middle market companies where there's a need to integrate the historical financials into the projected financials. And there's an assumption of a financing. So a company's going along and then there's going to be $5 million in outside capital invested into the company. How do you bridge that gap between this is what's happening, then there's this event? This is something that most companies really struggle with in putting together the models. So how do you think about it both conceptually and then how do you do it mechanically? And maybe when you work with the model, we can dig into it.
It's a great question because when you take on your first, typically for our clients, their first round of institutional financing, the DNA of the company fundamentally changes in many ways. So you suddenly have more cash in the bank than you've ever had, and simultaneously you need to put the dollars to work. So the question is, how are you going to do that? And integrating, looking at the historicals doesn't always necessarily show that this is going to be the ratio of salary expenses to revenue moving forward, or that this is going to be, the direct costs, the same ratio. Oftentimes those costs are going to increase, and that can generate a lot of questions with our clients around, okay, what does this mean? Net income goes negative, but then, is that okay? And so part of the job that we do is to show that growth path, because the worst thing to do to show when you're raising money is that money hits the bank and it sits in your account. So the larger point is that the historicals need to be incorporated. There needs to be some follow through, but oftentimes there are going to be salary adjustments to existing employees. There's going to be many new employees coming on. You're going to be plugging money into new marketing initiatives. And so the burn is going to be at a much faster pace than what founders are typically accustomed to. And there's sort of a ramp up just psychologically into getting into that headspace that the model work and creation really helps us bridge.
It's great because when we're asking, and so many companies that we work with, they're looking for some big sums of money, and there has to be credibility of how that company's management are going to be good stewards of that money. And as you said, it's not going to be simply sitting in the bank, but whatever those expenses are, whether it's hiring whether it's marketing, whether it's acquisitions, are well thought out and defensible. Okay, with that, Antonio, I think this is a good segue. There's a lot of questions that are going to come up that as we dig into a model. So maybe here we go. We're going to have this is a live model, and maybe we've redacted information about the particular company here, but this is a cool model because it really reflects a company with an awesome strategy. So maybe talk about the business and why this is this model, when folks look at it, they say, in addition to being just a really well thought out projections, it's reflecting a business with a solid strategy. So maybe just talk about the business, and then we'll dig into some of the aspects of it and how the assumptions flow into the financial statements.
Yeah, absolutely. As you said, this is a real company. It's one of our clients, and it's a very interesting company that we assisted in developing their growth strategy and raising their Series A round, which happened last year. And the company essentially produces and sells directly a very innovative coffee machine, and so product sales, but it also gives the users, the clients, the possibility to buy coffee beans directly from their own roasters marketplace. So it picked this one because not only is a great success story, but it also embeds two components of many businesses: product sales and subscriptions and other revenue streams. So there is complexity, but it's a great story for a company that worked with us, and we work with the CFO particularly to build this before putting it in front of venture capital funds, essentially.
I want to flag one key point here. So this is a company, and part of the reason they're able to raise an 8-figure sum of capital and is at an incredible valuation is that their business model is one that has all the aspects that anyone should be looking for. There's a product that they sell at a high margin. There is a recurring revenue component. There is tremendous brand loyalty that the product creates, and all of that's reflected in the financial model. Now, in this particular case, what's great, the company came with these aspects in place. Now, Antonio, maybe as you talk about, as part of putting together a model, coming back to that strategy question, before we can build the model, sometimes when we're looking at it, we're saying, this isn't going to work. The company doesn't have enough of the right stuff, and we've got to make some strategic changes, have some aha moments in the business model. So maybe before you go specifically into this, when you counter a company that their business model doesn't create enough excitement in the financials, what do you do?
Yeah, it's a frequent situation, and I must say, even in this case, there were some challenges. The model was already formed; their business model was already existing. However, and this was coming out of COVID, they had a lot of pre-orders, but they couldn't deliver on those orders, both because of lack of capital and because of the problems in the global supply chain. And so, how do you deliver growth continuously when your core revenue stream is halted at the moment? And so that's when they decided to invest in a community, building that community with engagement and pushing on sales of products, right? Mostly from the US. And so modeling the two parts, the product and the subscription, was an interesting aspect that both us, the company, and then investors later had a different opinion and different angles on.
And I want to ask a follow-up question on that there's often, when we're working with middle market companies, they have an aspect of their business that has real excitement in the financial model, and then they've got something that's more legacy, more service oriented, more retail, that may be generating the majority of the revenues. But when we're presenting the financial model, that may not excite investors. When you come across these hybrid business, which many businesses are, right? They've got aspects of it that they're paying the bills with, and then they got a new initiative that's very exciting. How do you kind of manage those tensions in the business strategy and then in the financial projections?
Yeah, it's a complex and very common issue, and it's a combination of working with the founders and owners to determine if there's a path forward that includes revenue streams that are more palatable or interesting to the typical venture capital investor. And so, or if there are other aspects of the company that we can play up, such as a massive and growing addressable market, name brand customer list that's very exciting. And then also looking at the right combination of investors to target the offering to, because some investors are much more focused on things like recurring revenue streams, consumer buyers versus businesses or vice versa. So it's a combination of sort of working what we have and playing up the strengths and appealing aspects of the company, recommending pivots and changes to the model when those things are feasible and defensible, and then finding investors who are interested in that combination of internal attributes with the company.
Really key insight that the financial projections model is obviously the meatiest part compared to a PowerPoint or a written business plan or executive summary. This is meaty. This is numbers. It is or it isn't. At the same time, we're still marketing. We're still highlighting. We're still thinking about the audience and about how to present a business that's most favorable. With that, okay. So Antonio, maybe dig in here, talk about the model, maybe about how the assumptions flow into the financial projections. And you got a lot of tabs here, a lot of complexity.
Sure.
So, how do
I'll
you
make it quick? I don't know how much time we have, so I'll try to make it quick.
No, this is good. That's much time as you need.
First thing I'll say is that people can probably see this is not Excel. This is Google Sheets. And we build sometimes a model in Excel, sometimes in Google Sheet, which can be downloaded into Excel. Very simply, it's mostly the same. The reason why we started to build a lot of models in essentially in Google Sheet is that there's oftentimes and more global teams that are all over the place. Our team and the client team, plus the investors, might be 12 people in 8 different locations, and so this avoids conflicts. Right? There's no version, August 18th version 3. This is always updated live, and so there's a great benefit. You share a link, and everybody can work or take a look at the latest version at the same time. Other times it's simpler to build an Excel, and that's entirely fine.
I got to stop right there. I want people to really appreciate. Give us a range of numbers of revisions on an institutional quality financial projections model. How many times is this being revised?
I'll answer first, but I'd like Predrag to also comment because he's got his own statistics. I would say that revisions. You don't even count those, but iterations of a model, formal iterations of a model from beginning of the process to the end of the engagement, say, we're talking about probably 10 to 15. In an ideal world, we do 2 or 3, 4, but in reality, there's so many inputs and so many considerations behind those inputs that it does require, sometimes a dozen iterations. And then a quick note, these models are built so that the client teams continue to use them. And when I picked this model before redacting it, I saw that the latest, this is an engagement from 2021, the latest change was done about a month ago by our client. So this it's the proof that there are tools for internal analysis, for planning for growth, for having a reality check of what you're doing, that you can continue to use long beyond the project with Growthink.
Predrag, any follow-up comments on that when you think about the revisions process and how many there are, and why is that? What does the client get from that?
Yeah, actually, the more serious the client is about the project, the more revisions there will be. And also, oftentimes, if he considers the model as the tool to get some insights, there's a lot of fine-tuning going on. Like you do a version of the model, and then you realize, okay, I might have a little bit, too low IRR, for example, and then you change some of the assumptions. Then you think about the ways, to change the marketing. Then you change the marketing assumptions. So it can vary greatly. It can be from 2 to 3 versions, but I think both Antonio and I had cases with over 30 versions of the model. And sometimes even this term converts into a long-term partnership with the client where you provide ongoing, advices, financial advices and support, and not just the initial package for fundraising.
Great.
Well said.
All right, Antonio,
so
we've got this summary tab. Let's dig right in.
Yes, I just want to highlight that what a lot of people see at the end of a process, in a business plan, in a pitch deck, in a presentation, out of a model, you would see this chart, okay, P&L snapshot. You'll see maybe how the funding needs, and then you'll see the so-called financial statements, which are in this tab, in this case, income statement, monthly and annually. I can't fit it all in my screen. Balance sheet, okay, just below it, and cash flow statement. This is probably, in fact, you would only see probably the annual version here to the right of income statement, balance sheet, and cash flows. But this is really the output, or one of the outputs of the model. But to build this and to get to this outcome, there's hundreds of assumptions that are built in there. So I'll open this tab, which is probably the real engine, the biggest piece and core to the model. This is where we estimate on a monthly basis everything from marketing initiatives to sales of the product, of the machines, and then later the subscriptions, accessories, and collateral revenue streams. So we won't have probably time to go too deep on this, but I'm opening, for example, the marketing to machines, the very first piece, where we start from budget for anything pay-per-click and advertisement, and with the inputs are the cells in blue, and with conversion rates we derive based on historical performance data like this one, and potentially an improvement of that. If we invest X in marketing, how many visits to the website, how many conversions we get, and therefore how many sales. And you can see that we're trying to cascade down from the initial initiatives to every step of the client journey. And then there is, in this case, complexity, because a machine there are inventory considerations, there are cost of goods sold consideration that vary depending on the supply chain. And so, but essentially we get to the number of machines sold and delivered in this particular tab.
And then, if I could jump in here, for this sort of company where there's equipment that's being purchased and then sold, the projections are critically important, because you're seeing in one place the timing of cash in versus cash out, which is just so important for companies that are growing very quickly to budget for that end of month cash number. So while we want to spend money to make money, we also don't want to run out of money in the process. So this very precise sort of timing allows us to plan and understand what level of cash cushion is going to be needed to sustain the company through this hockey stick growth.
That's a very good point. And I'll just add that this is what you said is exactly one of the reasons, probably one of the main reasons why this company was seeking external capital and substantial capital. But it's also the most direct and defensible way to ask for that capital to a venture capital fund, because they understand that it's a matter of cash and cash flows to sustain the business and to sustain the growth plan. Just by looking at this.
So now there's a lot going on here, and there's a lifetime of experience and learning that we cannot get into in the context of the time constraints of this podcast. What I'd like to wrap with, and I'd like for all three of you to comment on, maybe we can go to the IRR, the valuation page, and show how this company, how we justify, and this company wasn't generating a lot of profits at the time of their financing, if I recall correctly, yet was able to justify a mid-8-figure valuation for the business. So this is how entrepreneurial value and wealth is created. So maybe let's go to the statements and the cash flow and how that translated into a valuation justification for the business. And maybe you can comment on that, Antonio, and then Anna and Predrag, and we can wrap.
So I'll just say that I love how it's a very known scripted podcast, because in this particular model, we don't embed a valuation. We do oftentimes. It's not the case here. I'll say that for this particular company, that they had raised a seed round 1 or 2 years before this one. So they had a target valuation number that derived from the previous valuation and an increase and advancement in the business, and therefore a higher goal for the pre-money valuation for the Series A. And so we had some, you could say, cap table or board of directors limitations that we had to work with, which is part of the real world. As you said, the valuation was high by many standards, because if you took their pre-money valuation, that I don't know if we can even talk about that, but if you calculate the multiple with revenue, or even worse with EBITDA, you will see a very, very high resulting multiple. Okay, so ultimately what it came down to was the quality of the business, the product, and the management team. Of course, it was a convincing growth plan. Okay, a legitimate need for raising 10 million capital, and by the way, this became a 15 million investment, but and that, you know, made the deal work, aside from discounted cash flows, aside from enterprise value on revenue, enterprise value on EBITDA multiples that traditionally for established companies are very traceable and trackable. So ultimately, and I'll wrap here, the company had to preserve the majority control on the cap table, and the investors very well know that. So they were convinced by the product, by the management team, by the growth plan, I could say maybe by this model as well, and they've agreed to make a substantial investment for a minority share of the company.
And in that process, the financial model is contributory to that process, that the founders of the company saw a multi-million-dollar increase in their equity position, the value, the market value of their equity. And this was an integral component of getting them there. So this is where we talk about,
Absolutely.
you know, how value is created. This piece, from startup to defensible financial model to financing, this is by far, you know, think about like a baby. Like a baby goes from, you know, 8 pounds to whatever it is. They see something like they grow 300% in their first year of life. And that's the same idea with a company. By far, the value, the greatest, the steepest trajectory of growth for a company is in its early years. So maybe, and I know you've had some very similar client experiences like this, value unlocking that comes from this financial projections process. So what will be a closing insight to entrepreneur, executive that wants to utilize the financial model to unlock value? What would be an insight that you'd offer them?
Yeah, I mean, I think fundraising is so much about momentum and chemistry between the VC and the founding team, and the model gives the founding team the confidence and the wherewithal to build that credibility and be able to have confidence in investor conversations, because ultimately the VCs are sort of in the same place as founders, where they're looking at what's the valuation today, and 3 to 5 years from now, by what multiple can I increase in the next round or in an exit. So the financials present that credible case, and also give the founders that credibility to be able to, you know, make their case, and then focus also on the relationship with the VC and selling the larger vision and the story in a way that, you know, the guys in the other line, they're like, I get it. This makes sense. This is exciting. I want to be in business with you.
Awesome. Predrag, I'm going to give you the last word. If you had one insight to offer an entrepreneur and executive putting together a financial projections, what would that be?
Well, I'd like to, let's say, finish with the thing I like the most, and that's probably calculating the cash flows in a really accurate manner, because that can help the founders like determine the amount of funding they need and determine the timing of the funding. Many times people know they want an investment, but they don't know if they need 10 million or 15 million. So calculating the cash flows can also help define the investment and the overall approach.
Love it. Love ending with cash. Cash is the ultimate truth seeker in a business. So Anna, Antonio, Predrag, thank you for your insights, and I appreciate folks listening, and challenge everybody. Don't be intimidated by putting together a financial projections model. It's fundamental, and if there are areas of it that you're not sure about, those are things in terms of, as an entrepreneur and executive, those are growth opportunities for you. So great stuff, guys. Look for future content like this, and let's all everybody's entrepreneurial and business success. Thanks, guys.
Thank you, Jay.
Thank you.
Bye-bye.